Well, good morning, everyone. First of all, thank you so much for your time. We really appreciate it. My name is Doreen Walsh. I am the Vice President of Network Development for Dominion Lending Centers. Dominion Lending Centers is the #1 brokerage in Canada. We, in fact, did more mortgages than any Canadian bank last year. Varan, Karananantham is a top producing mortgage agent with Dominion Lending Centers. He's had the privilege of supporting clients and partners through a wide range of market cycles and truly believes that staying informed and connected is the key to a long-term success and evolving real estate landscape. Today's session was created with one goal in mind: to bring value to you, our trusted realtor and referral partners, by offering timely insights that will help you navigate and thrive in the current Ontario real estate environment. We know that the market has shifted, whether you're dealing with cautious buyers, sellers waiting on the sidelines, or navigating new challenges. The questions and conversations you're having daily will become more complex. That's why Varan wanted to bring together two incredible experts who can offer clarity, strategy, and perspective. First, we'll hear from Marianne Gillespie, a CEO and elite business coach who works with high-performing professionals across North America. She will be sharing with you a power session on why this is a market of opportunity and how you can harness that mindset. Then we'll be joined by Shelley Kashik, an economist with the Bank of Montreal, who will provide a data-driven look at where the Ontario real estate market stands today, and more importantly, where it's heading. From interest rates to housing supply and economic indicators. This session will give you the tools to speak with authority and confidence in your day-to-day conversations. This is part of Varan's ongoing commitment to education, support, and add value to the incredible network that we're all so lucky to work in. I know your time is valuable, and I'm excited about what you'll take away from today's presentation. With that, let's dive in. I'd like to introduce the man that has made this all happen. Varan Karananantham is a leading mortgage agent at Dominion Lending Centers. He's been helping Canadians navigate the mortgage process since 2007, and most recently founded Fides Mortgages. Varan wears many hats. He is a mortgage agent, a business leader, a mentor to many, a husband, a father, and an all-around great guy. Varan, I'd like to welcome you to everyone here.
Thank you, Doreen. Thank you for everyone who joined the session today. First of all, I want to say thank you to my team Fides to make this happen. We have 500 plus participants today, and I could have not done it without the support of my team. So thank you, Team Fides, to make this happen. We are here to educate our partners and our clients during uncertainty or not sure what's going on. And I would like to take a moment to thank you, Doreen, for being here to support me, Shelley, to give us some valuable knowledge, Marianne, who's here to motivate us and get us going, and Elaine, thank you for having this set up. Without further ado, I'm just going to pass the floor to my speakers.
Perfect. I'd like to introduce our first presenter today is Marianne Gillespie. Marianne is the powerhouse CEO of Red Apple Coaching and one of the most in-demand performance coaches in North America. She has directly coached over 270 verified seven-figure agents, helped build the #1 real estate brokerage in North America for production, and worked with the top 8 real estate teams. With over 32,000 hours of billable coaching, she has recruited over 350 agents and authored Canada's #1 real estate training course. Wow, a world championship iron athlete and published author. Marianne brings tactical expertise, mindset mastery, and a story of grit that inspires every audience. She shared stages with icons like Grant Cardone and Ryan Serhant, and her mantra is simple but powerful: anything is possible. Welcome, Marianne.
Thanks, guys. Thanks, Fides. Thanks, you, Baran. I appreciate it. I'm so honored to be here. I really love this. We are going to do a 30-minute power session here. So hopefully everybody can hear me, and we got some great feedback already. So guys, here's what I'm going to just say. We're going to roll into it, but be careful because I am super positive. I am the person, we looked at our quarter 1 stats as a professional. We have over 800 Canadian clients. And I will tell you right now, we know some of them are on here. We have crushed the stats right now. So we are ahead. We are at about 97% of our clients have hit their sales targets and exceeded what they did last year. So you're always, if you know me, you know that I am all about opportunity. I think this is the best real estate market that we've been in. I'm super positive about it. And I want to make sure that you guys walk away with the right tools. One of the things that we're going to talk about today, and I'm going to lead into it right after I tell you a little bit about myself, for those of you who don't know me. So let's pause on what we'll talk about in a second. So just to compliment, and thank you, Doreen, for the most amazing introduction. I love it. Never get tired of it. So as you guys can see, I've been published in Forbes magazine over 7 times for my knowledge and my predictions of the market. We've been right on every single market prediction. We have an 100% accuracy for the past 6 years. We've predicted the market, even in the most unpredictable times, because we study it aggressively. And we also know that a market is derived predominantly on emotions. Markets are derived on emotions. If the emotions of the consumer are in a place where they're not feeling like they're confused or they're not understanding what's happening, then the emotional output will far exceed any logical one. So that's why we really want to focus in on what are we doing in our own community as licensed realtors. And I am a licensed realtor as well, so I can speak to that as well. So as you can see, we do work with the #1 real estate team in all of Canada as well. We work with the top 4 teams in the Toronto Real Estate Board and surrounding area as well for production in 2024. I'm an Ironman World Championship athlete, and all of the above. And I have over 32,000 billable coaching hours. And if you know anything about coaching, you know that that's the number that says this girl knows what she's talking about. So let's dive into where I think things are going to be heading. So as we progress into our presentation here, what we're going to talk about is this. You have to really look at it. Scarcity and abundance mindsets. I'm an abundance thinker, and I can always feel when you have scarcity thinking versus abundance thinking. Scarcity thinking are people who are fear driven. They're going to look and they're going to be like, oh my gosh, I'm talking about you guys, sales reps. Okay. If you're fear driven and you're scared, you know what? You're going to be leading with a scarcity mindset. And my background also is neuroscience as well. So I'm a fully licensed practitioner in NLP. And one of the things that I always look at is your mindset fear driven or are you growth focused? A growth focused person is going to look at this market and go, yeah, I get it. I get it. Tariffs are happening. Things are happening. There's movement. But a growth mindset is going to turn around and go, wait a second, 5-year fixed rates? Pretty amazing right now. Pretty amazing. Where are you sitting? Are you afraid every time you look at the TV? Or are you leading with growth and saying there is an opportunity that we need to really pay attention to? A scarcity mindset waits for things to get better, right? You can hear that in some of your clients today where they're saying, you know what, I just want to wait. I want to wait. I want to wait. Things might get better. But an opportunity mindset is going to say, Marianne, tell me, where can I have some initiative? Where can I take action? That's a growth mindset. Focus on limitations is a scarcity mindset. You're very limited to your limitations. It's got to be this way or no other way. I'm not open to anything else. That's a scarcity mindset. An opportunity mindset is going to say, let's find ways that we can succeed in this market. So where do we want to be with me, guys? We're only going to be on the opportunity side today. We are not in the scarcity side. Rip that Band-Aid off and don't go there. All right. Here's a great example. When you're looking at a flow chart of where we are right now, good times create weak people. And I know that some of you might go, what do you mean by that? Well, I'm not going to lie. I think, somebody who's been in real estate for over 26 years, I have been. So long story short, I can tell you when the market is good, it doesn't create strength, meaning that it's very difficult to learn skills when the market is hot and it's on fire. So weak people create bad times. That doesn't mean you're weak as an individual. That just means is that, you know what? If you're not strong in this market, it's going to create some bad times for you. Bad times create strong people. Okay. That means that if you're going to look at this, and we're not going to lie, we know that it's not easy. Kind of like what Doreen said. We know it's not. Okay, so let's not even pretend. Let's not have total blinders on. But the bad times will create strong people. When you get to the other side of this market, you have no idea. You're going to be the strong person creating good times. Okay, so this is where we want to end up, and we're just in that transition right now. So you know what? Although you might be thinking this is a very difficult and hard market, we're going to get through it. Okay, I'm going to give you some stuff today. Where we really want to go today, and we'll get there in a minute, is more based on opinions versus facts. Facts are what we have to focus on with today's consumer. But before we get into facts, I'm going to explain to you a little bit of a mindset that I want you to have. When you're heading into something, anything new, guys, this is the comfort zone. The comfort zone is where 99% of the people that we work with, they come to us. Everybody starts in the comfort zone. You know what? When Varen was opening his new company, he probably started in the comfort zone. It was a thought, okay? He was thinking about it. He was safe, in control. How do you know as a realtor that your business is in the comfort zone? It's easy to do, okay? You are over here and you want to be here with your business. But what happens is that you're going, I know I want to be here, but I'm over here. And it's not very painful over here. I'm making enough money. I can pay the bills. I want to be here, but I'm not uncomfortable here. That's your comfort zone. There's no pain for you to go here. So you're staying here because you can, and you're okay with it. Everybody stays there. When you're a little baby and you want to walk, okay, you're comfortable crawling, but you want to walk. So until it gets painful, AKA you get too big, you're not moving as fast as everybody else, until there's a pain reason for you to walk, why would you do it? Why would you do it? You're comfy. So in the history of your life, you have always started in the comfort zone. It's where you feel safe. Let me tell you something. It's a liar. Nothing grows in the comfort zone. You got to get out of it. So whatever you're doing in your business or personal life, my mantra is always get out of that comfort zone. That leads you to the fear zone. The fear zone is where you've got a lack of self-confidence. It's normal. When you do something new, you're going to have no confidence. Okay, same thing with opening a business. Same thing with changing your scripting. Same thing with changing your mindset on something. You're going to have a lack of confidence. But then you're going to also have some excuses. You're going to hear that the market's no good. The tariffs are coming at you. I don't know what to do. The interest rates, nobody's selling their house. We're only selling 40% of listings. Those are the excuses. How can I succeed in this market when I have all these excuses not to succeed? You got to rip that Band-Aid off. Okay, when I show you some stuff today, you're going to go, okay, I'm ready for it. But finding excuses is what keeps you in the fear zone. It's what keeps most people in the fear zone. Don't live your life, don't operate your business finding excuses for everything. Rip the Band-Aid off. If there's house sales, and there are a lot of them, if there's house sales, then guess what? What's your excuse? Rip the Band-Aid off. Don't be affected by other people's opinions, guys. Look at the operative word there, opinions. Everything is an opinion. In a market like this, when we're recovering and we're going through some interesting times, a lot of opinions are circulating. Okay, stick with the facts. Stick with what you're seeing in front of your face. If listings are selling, you can sell them too. If buyers are buying, you can have buyers as well. Don't let opinions affect your outcome, okay? Opinions are just that. They are just opinions. Facts are what they are built on. Facts are what real stuff is built on. So try to stick with facts. We're going to help you with that today. Our whole team's going to help you with some great facts today. Next thing you do is when you break through that fear zone, if you recognize yourself in the fear zone, that's what's holding you back. Our job as coaches is to push you into the learning zone. Every facet of your life goes fear zone to learning zone. So watch for the learning zone. When you hit that, look at the thing that's on top of the word learning zone. It says you're going to deal with problems and challenges every time. Okay, so if you even look at Varen, he opened his new company, amazing, guaranteed he's having problems, guaranteed he's having challenges. That is the consequence of going to the next level. That's what happens. And you have to expect it. Most people will be scared to do that. So they'll sort of sit back and go, I don't want the problems because it's so nice, warm, and cozy where I'm sitting right now. You got to have the problems in order for you to grow. The problems are what defines that next level. The more problems you have, the more you're growing. You have to see it as that. See, if Varen, right this morning, just to be very honest, we had a panel login. And 5 minutes before, I'm like, we can't log in. It was blocking us from logging in. It worked, and then it didn't work. That's just how it happens. We would not have that problem if this was never happening. So if Varen never arranged this to happen today, we wouldn't have that problem. So therefore, is it really that big of a deal? No, this is what happens when you're in the learning zone. He's learning, he's got it, he'll figure it out next time. We'll figure it out next time. This is learning. You're going to have issues and you're going to have problems and you can't get upset about them. You have to look and say, that's the consequence of getting to the next level. It ain't pretty, but it is exciting when you have problems. So people can look at problems and get all, oh, I don't want problems. I'm going to try to protect everything. Lean into it, guys. As you're building your real estate business, lean into it. More problems you have, the better you're going to have, okay? Extending your comfort zone. And when you're past that, you're in the growth zone. And next thing you know, you run it through. Varen's going to hold many more of these. If he does, he'll get easier and easier and easier. He's never going to be back in the comfort zone for this ever again. And you know what? Will there be more problems? Yeah, if he grows bigger and builds it bigger, there'll be more. So guys, my biggest advice to you as you head into the rest of this year, and before we get into the statistical nitty gritty, is guess what? Not only get out of your comfort zone, because nothing's growing there, but get into the fear zone and really recognize everything coming outside of you is irrelevant. You're going to have a lack of confidence in anything new. You're going to find excuses of why it's not going to work because that's the way the brain protects you. And you're absolutely going to be affected by other people's opinions. Push through it. Recognize those 3 areas. Push through it. Get to the learning zone. When you're in the learning zone, understand, wait for it. What problems are going to happen? What challenges are going to happen? How messy is this really going to be? And then get buckled up and get ready to go because that's what we're talking about. Now, let's get into what we were really talking about, which is let's get our clients moving. Okay, where's the opportunity here, guys? This is opportunity market. Confidence, confusion, 2 different things. I was at a real estate conference, I think about a month ago. It was an amazing conference. Kudos to those who hosted it, but I'm not going to say who it is because there was a lot of talk around consumers not having confidence. That's not the case right now. I can assure you, I've been in real estate 26 plus years. Remember what I said. You can have all the facts in the world, but until you know what the consumer is emotionally feeling right now, you cannot say this for sure. I can tell you in the Canadian real estate market, especially, and the United States, but mostly the Canadian real estate market, especially Ontario right now, it's confusion, not confidence. And let me show you why. Confusion and confidence are super similar. On the left-hand side, you'll see consumer confidence. Consumer confidence being an issue would be decreased sales activity. Okay, we are hearing that that's happening. Longer days on market, we're sort of hearing that happening. It's not. Look at Sudbury, Ontario. Sudbury, Ontario is less than 3 weeks right now. So technically, that's not applicable to everywhere. Niagara is on the market for a long time, man. They got 7 months of inventory, I think, right now. But yet Sudbury has less than 3 weeks. Then you go to Oakville, it's trending 7 to 8 months. Then you come to Ottawa, it's got about 4 months. Like, it's not the same anywhere. Longer days on the market is not a universal thing right now. So not really accurate. Increased buyer caution, I would say yes, a little bit. So that makes sense. Price reductions, we are seeing them. We are seeing them. And we are also seeing not price adjustments. We're seeing over asking. Fewer listings, there's the thing. Okay? No. There's your key point. If there were fewer listings happening right now, like a drop in it, that would tell you confidence. But we're not seeing that, are we? We're seeing way more listings. So there's your first trigger. Second one, lower inventory activity. That's not true. Lower investor activity. That's not true anymore. We're seeing them come back. Tighter lending conditions. I don't know. I'm going to let the specialists talk about that, but I don't believe that to be accurate. It's wicked. I mean, 5-year fixed. Hello. Okay. Shift towards a buyer's market. Again, we're already in a buyer's market in many places. We're going to cover that in a bit. So in theory, I can understand at this real estate conference, the people on stage kept saying, work on the confidence of the consumer. That's what's slowing your market down. On the blind eye, that would appear to be true. It isn't. It's confusion. Now, I can tell you it's confusion because we have 800 clients and we work with the biggest teams. Some of these teams are selling 1,000 a year of deals. So we know that confusion and confidence are 2 separate things. It's confusion right now. When confusion hits, this is what happens. Conflicting market data everywhere Everybody's got an opinion about our real estate market. Every single person has an opinion, and it's very confusing. So if you're seeing one person say, yes, like this is an amazing market, and then you're seeing, I saw all these stats printed the other day because the stats just came in for March, and everybody's saying different things. You got some people saying it's a great market, and then you have all these postings saying decline, decline, decline. It's just like it's conflicting. Like, what is it? Is this a great market or is it a bad market? What is it? So how you see it. Shifting market conditions, as we talked about, it's different everywhere in Canada, Ontario. It's different everywhere in the United States. Okay, if you look at Boston, for example, versus New York, two different markets right now. San Diego versus Tennessee, two different markets right now. We have clients in all the states, and I'm telling you, it's really, really different in each one. Overload of information. Overload of information is a big one, guys. This is where it gets crazy. There's just too much information being handled at us. It's not that I think the information we're going to hear today is very valuable. What I can say though, is that sometimes as realtors, we can overload the information and the consumers will get that too. The consumer, we're doing the right thing. We're coming to the professionals, we're learning, we're listening. Today, you're going to get very factual, great stuff. So that's excellent. But when you're looking at this one here, the inconsistent advice and the overload of information, you got to think of the consumer in this case, not you guys. You're all here to get the right information. But the overload of information and inconsistent advice out there is so large right now that the consumer is going, I'm confused. That's what's happening. Misinterpretation of trends. I'm going to prove that to you. Okay, we're going to give you some goodies. Unclear mortgage and financing terms. Again, I'm going to leave that to the professionals, but I'll be honest with you. There's very few people that even know right now what the 5-year close is. There's very few people when you post that the rates are dropping, they think that that's prime currently. Like there's a lot of confusion on what that is. The public has no idea. They're being given information, third party, fourth party, very biased, and then misinformation on social media. We're not even going to go into that. Because if you looked at yesterday, there was a lot of misinformation, tons of misinformation. And I think for us, at a time like this, we stay away from it. Okay, so take a look at this. This is what a consumer could see. Tell me this isn't confusing. These are all media headlines, all of them. In February 2025, Canada's housing market experienced a housing starts decrease from 4% in January. Okay, then right after that, there was this one. Actual housing starts in urban centers with populations of 10,000 or more were down 17%. Okay, so I'm confused. 4% in January, 17%. Okay, I'll try to follow it. Now, here's 3 headlines about decreases in housing starts or housing starts. Montreal had a 6% increase year over year in housing starts. Okay, so Montreal went up. Vancouver, 48% decrease. Okay, but it's not year over year. It's compared to February of 2024. So they extracted a month. Toronto experienced a 68% drop in housing starts from the previous one, also due to decreases in housing categories. Okay, so the consumer sees 3 different things right now in the headlines. Then it goes in, these are all from CMHC, and I love CMHC, don't get me wrong, but this can confuse a consumer. This is what we're talking about. We're not disparaging CMHC. We're pointing out that they said Canadian home sales post biggest decline in nearly 3 years. Then underneath that, they posted within a very short time frame, Canadian housing starts rise 3% in January. And then underneath that, then Canadian housing starts fall 13% in December. So December, it was falling 13%, and then it rose 3% in January. If you don't think this is confusing, it's confusing to me. So if it's confusing to me, then it's confusing to the consumer. So let's roll into this, guys. Let's go into the facts. The fact is that every of the last 4 recession and tariff periods are indicated on the left-hand side. And the recovery of price increases happens within 2 years. It is a historical pattern in Canadian real estate. When you deal with market shifts like this and you go through these tariff wars and recessions and all of the above, the hidden silver lining is that it's usually a 2-year period, almost exactly from when it starts to when the prices go through the roof. If you don't believe me, remember, I'm not here to give you opinions. I'm here to arm you with facts. So let's look at the Canadian Real Estate Association. CREA is where the facts are. NAR has the same ones. Let's take a looky look. what we've got here on the left-hand side is the average sale price. You can see at the bottom, the markers of the last recessionary tariff periods are all located there. On the right-hand side is the sales activity. If you look at the dots, yes, look at this. The sales activity, again, prices dropped in 1980, but look at the sales activity. Boom, bum, 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 bum. And then look at this, prices went up. Same thing with 1990. A little bit of a reprieve on the prices from 1988, 89, and then boom, they went back up right after. Same thing with 2008, and same thing, well, we know what happened in 2020, okay? These are for your consumer. The Canadian Real Estate Association shows you these. It's on their sites. My highest suggestion is if you have people who are waiting to get to the other side of what's happening in the economy, my suggestion to you guys is start pointing a picture out that is positive. Start showing a picture that is very good, a picture that shows that, look, you know what? This is a reprieve. This is an opportunity for those of you who are buying and selling to jump into the market before the next wave hits. Take a look at the left-hand side. The average sales price, according to the Canadian Real Estate Association, shows very clearly with the two red bars, we are going up, baby. We are going to go up. In 25 and 26, we're going to start in 25, probably very, very end. And then 26, we're back up. Okay. So 27 is when they're predicting we'll go right back into those 22 kind of area pricing. We'll bridge a very big gap by 2027. So the truth is that it may be a little dicey right now. Okay. It's a little bit confusing. I think it's confusing. Sensationalism is always going to sell more than boring. Okay. But the reality is that this is the silver lining. So you've got to show this to your consumer and say, hey, there's a lot of opportunity window opening up right now. Here's another thing. Again, the only reason I'm showing you guys this is to show how crazy the media has gotten with pricing comments. Look at here. Home prices in GTA declined 20%, almost 19.2 since their peak in February 2022. Yes, I'm just going to tell you something. So has my weight. My weight has declined and increased a lot since February 2022. What does that have to do with anything? We have good years, we have bad years. Of course it has. Then you see at the top, you know what? Spring shock. Canadian home prices take unexpected plunge. Okay, unexpected plunge. I didn't see an unexpected plunge, but maybe you did. I didn't see one. That was just posted less than a month ago. Then you have another one. The area has seen a 21.7 decline in home prices since December of 2023. Okay, to be fair, we had a 22% increase in sales that month. So it makes sense we're going to have that. Okay, so the point is that every media sensation out there starts talking about the doom and gloom. This is what your consumer sees, 10,000 of these a day. So you have to sit back and say it's normal for people to have information that they're perceiving in a different way. It's very normal. But the reality is that these are opinions. They're grabbed to make headlines. So when you have headlines, it doesn't mean they're accurate. You have to learn how to help the consumer with things. So I'd like to thank KW Research for some of these statistics, which are phenomenal. So we do ask that you do not share these out to the public. These have to stay within. Okay. So the point being with this one here is take a look. All that stuff about Canadian home prices, take a look right now. The blue line is 4%. The blue line is in Canada and the United States. There's a 4% benchmark, okay? And every year they say our housing industry should go up 4%. So in pricing. So you can see since 1990, okay, which is 35 years ago, we're going 35 years back. It started to be, we were a little bit under. And then all of a sudden, right around 2006 to 2008, we saw an increase. We started going above what is typically that moving 4% price range. Phenomenal. Okay, but if you bought a house, for example, in 1994, it would have been about $158,000. In 2004, it was $226,000. So although we stayed below the 4%, your housing prices still went up substantially. And we had 2 recessionary periods within there with tariffs as well. So like there's a lot of stuff in there. So over every 10-year mark, this diagram, if you use it with your clients, shows that real estate pricing in Canada is outstanding. It may not be outstanding if you buy like in 2022 and you sold the next year. that would be a little bit of a bobo. But the long-term effect of Canadian real estate is absolutely phenomenal. So why are we ignoring this? The other thing you want to look at is when everybody's talking about the prices, we're still 19% above the Canadian historic pricing trend right now. That's not a little bit. 19% above is outstanding. If somebody at the bank told me that my investments were giving a 19% return, I'd be like, whoop, whoop, right? Like, so, but yet, why are we looking going, the housing prices are terrible? This is it, guys. This is the difference between opinions and media sensationalism or true facts. We are in the best darn profession, I think, in the industry. I love realtors. I love our industry. I love what we do. And we are literally, we are commission drivers. We are the only people who are sitting out there in COVID that we're not first responders, but we all stayed working. We put our lives at risk. We worked through COVID. We're commission businesses. We have watched our industry get really, really, really put all over the media for everybody to see. So if we don't have tools like this is my job, is to bring it to you guys and say, it's not that bad. There are facts that we're avoiding because we're sitting back and we're not standing up for our industry saying this is actually a great time to be in business. So take a look. Yes, in 2022, we were 33% above the pricing trend. That was an anomaly. Okay, we'll talk about that in a second. We are still 19% above trend. Absolutely brilliant. I don't see it going below that. Okay. So this is a great slide that you could show your consumers if they're worried about buying a house, show them and say, anywhere on this chart, can you find a 10-year period where housing prices didn't go up significantly? It's phenomenal, guys. Phenomenal. So I usually like to show that to clients and say, get positive. Okay. So we're going to take a look here. A great little script. Let me just see here. I'm just making sure I'm on par with everything. A great little script that I have currently is this one here. All right, because I don't have a ton of time today, but I will tell you. And going back to it, actually, I'm going to go back to this one. With the housing prices trend, I also want to show you something too. I think I took the slide out, but I also want to show you guys, these are the home pricing trends. I'm going to tell you something. In Canada, just so you know, we have only been in a buyer's market. We have only been in a buyer's market 2 years. That is it. We have been in a buyer, maybe 3 actually. We came very close to it for a 3rd year. In 35 years, we have been in a buyer's market for only 2, if maybe 3. Okay, so we can squeeze 3. I think we can squeeze 3. A buyer's market means 40% or less of listings are selling. We are currently in many places in a buyer's market. We won't be there long. My point being, guys, is this. The home prices are outstanding in Canada. We've been in a buyer's market only 2 to 3 times in 35 years. This is an opportunity. This is the biggest opportunity for your clients ever. And I do have the charts. You can reach out to me privately and say, hey, can I have the charts for that? I'm happy to send them to you. But the reality is this. 2 times in 35 years, we've been in a buyer's market. So the reality is that if that's the case, how many of us are taking those stats, which you can easily take, you can chat GPT them, you can do the charts on them, they're everywhere. CMHC has them, CREA has them. 2 times, if maybe 3, buyer's market in 35 years. So if you show that to a consumer, along with the pricing, along with everything, saying, what are you waiting for? We've been in a balanced, if not seller's market, over 35 years. We've been in it over 90% of the time. Only twice, maybe 3. Okay, so it's a stretch. It's like by 1%. So 2 times in 35 years, we've been in a buyer's market. I personally would say, what are you waiting for? Great interest rates right now. Amazing inventory out there. Housing prices that are showing consistent growth over the longevity period. And for the first time, really, in 35 years, we're entering a buyer's market for a very short time period. It won't last. The housing starts aren't very nice. So you know what? That's not a bad thing for us as realtors. But if you're not educating your consumers on statistical proof that this is true, then your consumers are sitting there going, well, I don't know what to do. Okay, show them the stats. There's too many things that are very positive about this market. Okay, and I'm telling you, it works. Many consumers. We have so many coaching clients sending us messages saying, Marianne, I mentioned it, my consumers and my clients, they love it. Okay. So here's a great script. I have 2 scripts for you that I'm going to show you. As you know, I'm a script master, and feel free, if you need anything, reach out to me. I only have 30 minutes, so I'm trying to go as fast as I can. Here's a great script for today's buyers. I understand that the market might seem uncertain, but the best deals always happen when others are hesitating. So with rates starting to decline and more homes are available than ever, we have the potential to negotiate better prices and amazing terms right now, which is something that disappears when the market heats up. This is the truth, guys. You've got to let consumers know that what are they waiting for? We have a housing crisis in Canada and the United States. We know that. The housing crisis is a serious concern. The facts that you see about the housing starts, those are actually true. We do have an issue with housing starts, which means one thing. That means we're going to run out of houses, okay? And we are going to run out of them. When the rates get too low and then consumers start buying and heating up the market again, and they get less confused, they're going to eat up the market. And you guys all know we're going to be back to multiple offers. We're going to be back to first right of refusals or conditional offers. You won't have the chance to be able to sell a house and buy a house at the same time. This is a beautiful market right now. And also, I always say this to people, you don't get the right to complain about all the costs of what the houses go up at and what the prices will be in 2027 if you choose not to participate in 2025. It's the difference, right? So, script for realtors talking to sellers. I completely understand your concerns, but let me show you the data, okay? Homes are still selling and demand is climbing back up. By the way, go to your office and ask them what the weekly appointment numbers are. They're on the increase. The best move is to price competitively your house right now. We'll market it aggressively and we'll take advantage of the buyers who are entering the market before the rates drop entirely to the point where competition increases. And if we're buying as well with you guys, we're going to have the leverage of both sides of the transaction right now. That is amazing. Okay, amazing. Now, where's the opportunities right now for you guys? Let me tell you something. Eat this up. If you are not jacked up and excited, remember what I've just told you. The data exists to show housing prices are outstanding. You have to look at the big picture. Don't look at the media telling you to look at one little snapshot. Get the proof out there. Show them also how often has your city been in a buyer's market. Most of you on this will be less than 2 times over 35 years. Show them that inflation has always been up and down. It has never been a flat line. Okay, just like my weight, it is never the same. Okay, 1 month over another month over another month. You know what? Last week I had a giant burger. You know what? I did not weigh the same last week as I did this week. Inflation is a serious thing, but it's not serious for us. Okay, guys? It has always been up and down. The government and the reps and everybody, they will come in and take care of that. That's their job. Our job is to show opportunity. There is. Now, what's the opportunity right now? More realtors are giving up. They're giving up because they're buying into the headlines, okay? They're not watching the facts of the great people like we have today. They're not watching that. So there's less competition, which is good. Weaker agents are exiting the industry. That's not you guys. You're all here. So this is your chance to stand out and take market share. I'm a coach. I have every team that I have hunkering down to appointments right now. Why? We're going to take every bit of market share we possibly can. Why? Because that's our opportunity. You are missing a window of opportunity. When others are scared, you lean in. You lean in and you grab it, you get the facts, and you own this market, guys. This is your moment, okay? I'm telling you, very big opportunity. More motivated buyers and sellers. This is a serious market. You're going to get buyers and sellers that are serious, very important. Listings are sticking around longer. Why are we looking at that as a bad thing? Okay, some of you may not have been in real estate as long as I have, but I'll tell you right now, those listings are lead magnets. So you know what? You can market the listing now. You can build your brand. You can't build a brand if your listings sell in 24 hours. This is a big one for you guys. Take the orange, which is the listing, squeeze as much juice as you can out of it. We finally have that opportunity. 2 years from now, you're going to love getting the multiple offers and selling in 24 hours, but you won't have time to market properly, get more leads, and learn how to brand yourself. Very big opportunity. Expired and terminated listings are gold. So let me tell you something, with only 40% of listings selling on the market right now, what does that mean? 60% opportunity of listings that are expiring or canceling. We can't in Ontario, many places you can. Ontario, you cannot solicit them, but you can have campaigns running for second opinions online, attracting it. So you can highlight and market yourself as an expert with cancel, expired, or unsellable listings. This is a window of opportunity for you guys. Really, really, really good as far as I'm concerned about that one. Okay. And that's really good. Yeah. Make sure you tag. Make sure you tag us. Absolutely. Okay. So creative deal structures are in demand. From seller financing and rent to own, you get a deal maker. I strongly suggest that you attend as many sessions with your mortgage representatives or Veron's team and whatnot. Learn what are the actual creative financing. He told me a couple of financing solutions and I was like, what? I was like, really? I was like, this is incredible. If you're not talking to your representatives or getting the education from the right people, you're going to miss this one. Open houses are back and underrated. Tremendously underrated. I will tell you something. We're going on an open house junket. We're going to 9 cities across Canada, and we're starting in May. And I will tell you right now, I have $1 million open house session. And let me tell you something. If you're not making $390,000 a year on open houses, this is the market for it. And it's not going to go away. It's going to be around for 2 years. So this is a good one for your business. Huge. Builders and investors need you. This is the time to go develop those relationships. When they're struggling, offer to help. That's our job. That's what we're here for. Wonderful time to build the relationships. I'm telling you, go to the builders, ask them how you can help, put their inventory on the market. What can we do to assist them? I'm telling you, gold mine right there. AI and social media are free tools. So this is your chance to create niche markets. Very important to lead into it. When there's a lot of activity, you can create a niche market right now. Be the person who sells the listings. Be the first-time homebuyer specialist right now. Lean in with your mortgage reps and be like, let's do as many first-time homebuyer sessions with creative deal structures and all that stuff. Can we do one? Do one every single 2 weeks. What is you waiting for? It's amazing. Okay, this market builds legends. This is what I want to leave you with. Tough markets forge elite agents. You don't grow in comfort, you grow in challenge. The tougher the market, the better you are going to grow. You will become an elite agent. I am telling you right out of the gate, the most important thing about this market is the list of opportunities that exist out there. Our clientele is crushing it. And they're crushing it because if we go back to the very beginning, are you seeing it as growth? Are you scarcity mindset? Are you looking at the facts and saying, these are factual. This is a darn good market. It is confusing to the public. So what do we have to do? We're the best darn people I think in the world. Our careers, nobody knows how hard we work. As realtors, we work day, we work night, we work weekends, we sacrifice everything. We went through COVID, a global pandemic where we had to show houses, buy houses, list houses. We are the largest contributing profession to every community that we're in. We are the ones getting booths in the community. We're the ones volunteering in the community. We employ people in the community. We are always in the community. Our profession leads in community development and support. We are amazing. So let me warn you guys about something. You hear a lot of opinions from the media. That is what is slowing down a lot of the market right now. Facts are what you're here for today. Facts are what you're going to get today. Look at the facts of all the opportunities that exist and make your brain see what I'm hearing and what do I actually see as the window of opportunity. Everything you hear today, what can I do with it? Look at this and say, how can I grow my business? Look at the stats and say, I understand how confusing this must be for a consumer. But what do I have to say about that to get our consumers seeing that this is an opportunity? We all know, before I leave, guys, we all know this, okay? The most important thing about what we're talking about today is this, is that we are powerful as realtors. We're amazing at what we do. but we have to be the leaders in facts. We have to be the leaders that tell the consumers for years they've said it's unaffordable to get into our market. They never have opportunities. We fought high interest rates, high prices. We fought multiple offers, 200,000 over. This is your moment. We have a window. We will be back in that market eventually. I can guarantee you that. But right now we have a window. So first things first, you can download the content there. I want to say thank you to the team, Varen, Doreen, Shelly, everybody. Thank you for having me as your real estate coach guest today. And if you guys need anything, let's talk later. But thank you again. Have a great day, guys. We'll talk to you later.
Oh my goodness, Marianne, that was incredible. You actually reminded me of Warren Buffett saying, when people are afraid, be greedy. And
Yep.
I just think to myself, yeah, I'm going to be a greedy legend. Exactly what you had down. Who's with me? So,
Yep.
we'd love to hear from all of you, how you're feeling and moving forward. And please tag Fides Mortgage in your commentary. So once again, on behalf of everyone at Fides Mortgage, that have helped put this session together, we appreciate your time here, and we're here to support you and your clients. So we've prepared a short video, and I'd like you to take a moment and take a look at that.
Trust. It's the foundation of every decision you make. And at Fides, it's what we build on.
Because finding the right mortgage isn't just about numbers.
It's about your story, your future.
At Fides Mortgages, you're not just another client.
You become family, and family deserves more.
More clarity, more confidence, more care.
From the first conversation
To the final signature,
We're with you every step of the way.
You'll never wonder what's happening or feel unsure of your next move.
because we make it simple.
With Fides, you're backed by a team that listens,
Understands.
And delivers.
we're not just your mortgage broker.
We're your guide,
Your partner,
Your safety net.
like the elephant in our logo, strong.
Loyal and steady.
we lead with purpose. We never forget what matters most.
You.
Fides means faith.
And that's exactly what we bring in every relationship.
Faith in your goals.
Faith in your dreams. Whether you're a first-time home buyer,
Refinancing.
Or planning your next investment.
We eliminate the guesswork so you can move forward with confidence.
and as part of our herd, you'll always know you're in the right place.
With the right people.
Join the herd.
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 Join the herd. Join the herd. Join the herd.
Join the herd.
I love it. All right, everyone. Our next presenter is Shelly Kaushik. Shelly joined BMO in 2020 and conducts research on the Canadian and regional economies. She also supports on fiscal policy and country risk analysis. Prior to joining BMO Economics, Shelly worked on a fiscal policy at the Department of Finance for Canada. She holds a bachelor's degree in economics and from the University of Waterloo and a master's degree in economics from Queen's University. Welcome, Shelly.
Thanks so much, Doreen, and thanks, Vern, for having me. Hi, everyone. Hope you're having a great morning so far. I'm here to try to explain the economy to you, which is a little bit more complicated of a job than it was just a few months ago. And a lot of that is because of tariffs. Now, sorry? Oh. doo-doo-doo.
I think top left from beginning, from current slide.
Yep.
Yeah.
How are we looking?
Okay, whatever, you go.
Okay. All right. So tariffs are, changing by the day. I'm going to spend a lot of time kind of explaining this confusion to you, and a bit less time than, what I would normally spend trying to explain what's going on in the rest of the economy, because so much of it does depend on the tariff situation right now here in Canada. So we've had a lot of announcements, a lot of back and forth, a lot of chaos, and a lot of media attention placed on tariffs. But what are tariffs in the first place? Tariff is a tax on a good, in this case, that is applied when someone is buying a good from another country. So what the U.S. government is trying to do here, and it is still the new U.S. administration, it's only really been a few months, and they're trying to impose tariffs to either stop U.S. consumers from buying goods from other countries, and to try to get them to buy U.S.-made goods, and also to get businesses to either stop buying, again, goods from other countries, or to bring their production lines back into the United States. So that is one of the many goals that they have here in imposing those tariffs. Now, we are coming at this new tariff world from a number of decades of kind of moving towards free trade. So we've actually been adjusting a lot of the global economy. Pretty much every country has to rely on the United States and to trade either freely or with lower tariff barriers than what we're experiencing now. So a lot of countries, again, are focused on trying to sell their goods to the U.S., and now they're finding it a lot more difficult to do so, including Canada, which is, of course, a much smaller economy than the United States. It's also right beside the United States. It's also rich in minerals, a lot of things that the U.S. wants. And because we share the longest undefended border in the world, of course, we have a lot of production lines that are, kind of intertwined and have been for a number of decades. So this is really a shift in how we view global trade, global commerce. And on top of that, again, it's not just a shift. It's the fact that, again, there are a number of announcements that get pulled back, get delayed, a number of news headlines that might be misleading. Marianne touched on that as well. A lot coming out from the White House, coming out from the media, coming out from talking heads. So I'm going to take a step back, and instead of going through all of this chaos, I'm going to do my best to try to explain what the tariff situation looks like right now. So as of the latest announcements yesterday, last week, etc., the United States government is imposing a 10% tariff on almost all of the countries that it trades with. That 10% number went up by a lot, by about 50% for some countries as of yesterday. But then yesterday, the United States government then shifted that tariff rate, whatever it was. Again, Vietnam was looking at about 50%, Cambodia was looking at about 50%. Those rates all went back down to 10% for every country except for China. China is now looking at a tariff rate of over 100%. Estimates vary on exactly what the details look like, but we're looking at about 125 to 145% tariffs on China, which is a huge, huge shift. Of course, China is the second largest economy. We know how much stuff is produced out of China, and so that is a meaningful shift in trade policy. Now, Canada and Mexico are kind of a unique case because they were exempt or kind of flew under the radar with these latest changes that we saw over the last couple of weeks. But that's not to say that everything is fine and dandy in Canada either, because Canada and Mexico actually were in the spotlight for the first few months of this new administration. And again, we had a lot of back and forth on what the tariffs on Canada looked like. But as of right now, Canada is facing 25% tariffs on steel and aluminum. All steel and aluminum products that go into the United States from any country face 25% tariffs. But that affects Canada most because Canada is actually the largest supplier of both steel and aluminum from any other country into the United States. We've also got 25% tariffs on all autos that are not made in the US going into the United States. And in about a month, we're going to get 25% tariffs on all non-US made portions of auto parts that are made in the that are not made in the United States. Now that is a lot more complicated because for anyone, a lot of people know this in Ontario, but for anyone who's bought a car recently in the last 50 or so years, really, you might know that we're not really talking about, the American auto manufacturing industry, the Canadian auto manufacturing industry, the Mexican auto manufacturing industry. Those don't really exist anymore. It's really the North American auto manufacturing industry, and it has been for about 50 years at this point. And so there's really no mechanism to figure out exactly what portion of each part is produced in the United States, because each part goes across the border countless times before it's finished, let alone each car with, thousands of parts in it, right? So this is, again, very, very complicated, something for the trade lawyers to figure out. Very glad I'm not one right now. Those are the two major tariffs that we're dealing with. We've also got those original fentanyl related tariffs that were 25% on all goods coming from Canada to the United States, except things like energy, critical minerals, potash. Those are being taxed at a lower 10%. Now that applies to, again, everything going into the United States that is not covered by the USMCA. Another big question we get, what is actually covered by the USMCA? Great question. We actually don't have data on that, because previously it didn't really matter for a lot of businesses. Again, depends on the sector. A lot of businesses didn't even bother trying to fill out that paperwork to get, officially recognized that they were covered under the USMCA, because tariffs used to be so low that it really wasn't worth it. Now, of course, everything has changed. If you aren't covered by the USMCA, you might get tariffed at 25% or 10% for those specific items. And so I can imagine, again, the trade lawyers are dealing with a lot of backlog right now, trying to fill that paperwork right now. But at the end of the day, eventually we do expect that about 90% of what we send to the US is going to be exempt from those tariffs. That, again, does not mean we're out of the woods yet, because we also have a number of threats on sectors that do actually have quite a large impact on the Canadian economy, things like softwood lumber. We're also looking at potential tariffs on semiconductors, which of course go into a number of items. It is really a fluid, moving environment right now. Things can change, not just every day. For anyone who was paying attention to the news yesterday, things can change not just by the hour, but by the minute. Things can change, by the time I finish this presentation. So we have to really be fluid here. It's a very fluid environment. It's a very nimble environment that we're in right now. For Canada's part, we have counter tariffs and countermeasures of our own. We've got retaliation from the Canadian government of 25% tariffs on about $60 billion of imports coming in from the United States. We've also got 25% tariffs on autos coming from the United States to Canada. But I think what the main thing to kind of keep in mind while we kind of move on, try to look at the rest of the economy here, is that, yes, there is a lot of uncertainty here. And when we think about things like uncertainty, there are two things to keep in mind, especially when we're thinking about tariffs as well. First thing, tariffs do not have a uniform impact on the economy. It really depends on what sector you're working in, what sector you're exposed to. That will kind of determine how much tariffs matter for you. So a very kind of clear example of that, again, Canadian energy, it's getting taxed at that lower 10% rate. Why is that? Well, Canadians, we send a lot of crude oil to the United States. And those US refineries that are taking that crude oil, they have very few alternatives. So if they're getting a 25% tariff on Canadian crude oil, they're going to look, okay, do we have that domestic supply? Not at the right quality, not at the right price. Can we get it from another country? Again, not at the right quality, not at the right price. So their options are very limited. And so that's actually why they had that lower 10% tariff, because on something like Canadian energy, it's a lot easier for Canadian producers to pass along those higher costs to their US consumers, because again, US consumers don't have much of a choice here. On the flip side, we have a lot of manufacturing and production lines, again, that are very highly integrated, like, for example, the auto sector. And so that's why we're getting into these situations right now where we already have a number of announcements coming out of the auto sector of temporary layoffs or plant closures. And it's because, again, in the short term, auto manufacturers are really struggling to figure out, okay, how do we even know how much we are being tariffed right now? And then over the medium term, can we continue like this? Again, parts go across the border quite often. And then over the long term, sure, okay, one way to avoid these tariffs is to bring a lot of production back to the United States. But that requires time, many years, requires a lot of capital spending. It's very expensive. And more importantly, it requires some policy certainty. And we don't really have that right now because everything is changing very quickly. So again, that kind of gets back down to the point. There is a lot changing right now. We on our behalf, we have to make forecasts. That's our job. And again, a lot of economists are struggling right now. What exactly do we forecast for the Canadian economy? Now, tariffs do two things kind of immediately. One is because they are a tax on imports, they raise prices. That is almost an immediate impact on from tariffs. What they also do, especially in a country like Canada, which depends so strongly on trade with the United States, we see a very significant, could be very significant drop in economic activity. And so again, a lot of economists have a lot of different assumptions underlying this. There is a huge range right now. We are, for our part, expecting a recession actually in Canada this year because of that significant economic impact. Now, again, not everyone is expecting a recession. Totally understand. Totally, it's a job where you have to be very humble right now because again, things are changing a lot. It also depends on exactly what kind of assumptions you use for tariffs, which again change very quickly. So we are expecting these tariffs to remain in place until about the middle of next year. Whether they actually get lifted by then, it's really anyone's guess. Again, they could be lifted tomorrow. We don't really know, but we're targeting the middle of next year because that's when the USMCA is scheduled to be renegotiated. So one of the, theories out there on exactly why Canada and Mexico are getting hit with tariffs is because potentially the US government is looking to get a little extra leverage for those USMCA negotiations. So if that is true, then we could expect those tariffs to be lifted in the middle of next year. But again, it's really anyone's guess right now. So just to bring it all back to what we're looking at for the economy, again, we are expecting a recession in Canada this year. We are expecting a recovery starting next year, again, when those tariffs are lifted. But for both years, we're expecting growth to average just 0.5% right now. Now, what does all of that mean for the Bank of Canada? Well, we know the Bank of Canada is dealing with this upside pressure on inflation from tariffs. That in and of itself would indicate that we want interest rates to be higher to keep inflation at target. But we also have this downside risk, this impact on economic growth, which in and of itself would push rates lower. So we have this one pressure pushing rates higher, one pressure pushing rates lower. It really depends on exactly how these play out over the coming months, over the coming quarters. And again, a lot of people have different opinions or forecasts on this. Right now, for our part, we are expecting that economic downside risk to outweigh that upside risk on inflation. And so on net, we are expecting a further reduction in policy rates from the Bank of Canada. So we have 3 more rate cuts penciled in for the Bank of Canada. That would bring the overnight policy rate to 2%. It's currently at 2.75%. So that's an additional 75 basis points of cuts. And just lastly here, I'm not going to touch on it too much, but again, if you have any questions, feel free to ask them at the end. We are expecting an additional weakening in the Canadian dollar. So that last chart there, that's the Canadian dollar in Canadian dollar terms. So if the line is going up, that means the loonie is weakening. And so that's why we've got an additional weakening, again, until the tariffs start coming off and we start seeing a recovery in the value of the loonie. Now, if we zoom in a little bit, I did allude to the fact that the impact of tariffs is not uniform across the country, depends on what sector you're in. And because of the way that this country is set up, it also depends on which province you're living in. So we did a very quick look. There's a few ways to measure this, but we're trying to look at exactly which provinces are the most or least vulnerable to this tariff regime. So what we have here is the share of goods that get exported to the United States as a share of each province's GDP. So exactly how big these exports are, again, relative to the size of the province. And the first thing that stands out here is Alberta. Alberta clearly is the most exposed, the most vulnerable to US trade. But a lot of what they are sending to the United States is energy. So I did talk about the fact that energy is a little bit more insulated from the effects of tariffs because, again, there are fewer alternatives. So if you take off energy, so if you take off that green section on each of the bars and you just focus on that blue, so that's non-energy exports, you can see pretty clearly that Ontario and the rest of central Canada, even New Brunswick to a degree, are kind of facing the biggest risks. And again, that's because a lot of what we're sending that isn't energy is related to that manufacturing, especially in autos, and that's especially the case in Ontario. And that's why looking ahead, we actually have Ontario lagging all of the provinces for economic growth in both this year and next year. So we are expecting a contraction in the Ontario economy this year, a bit of a recovery next year, but again, it's going to take some time once tariffs are eventually lifted, depending on when they're actually lifted, depending exactly on how autos get treated, things like that can change the forecast quite drastically. But then on the flip side, we also have Alberta, Newfoundland, two of the most energy intensive provinces leading the way in economic growth this year, and Alberta continuing to do so next year as well. Now, if we zoom out again to the rest of the country, I do want to stress that yes, tariffs are a big deal. They are going to be a major hit to the Canadian economy, but actually, coming back into this Canadian economy, or sorry, coming back into this trade war, the Canadian economy was actually doing pretty well for itself. And that's because the Canadian economy and actually Canadian households are some of the most interest rate sensitive in the world. And so we saw the downsides of that in 2022, 2023, when rates were rising very rapidly. We saw consumers pulling back quite significantly from spending, right? It's too much of a shock. They just weren't able to keep up spending. And so we saw economic growth basically stabilizing, stagnating even for a little bit during that time. But then we saw the flip side of that, or started to see the flip side of that in the second half of last year when rates started coming down, right? Suddenly things are a lot cheaper because you have so much debt. Again, if you're paying less interest on that debt, you have suddenly a lot more room to be spending money on whatever restaurants, clothing, whatever you want. And businesses, same thing. Businesses are investing more. So we saw a pretty good momentum, I would say, at the end of last year in terms of consumer spending, in terms of production. And so generally speaking, we're coming at this from a pretty decent position. And so we do have some, kind of strings of underlying momentum as we get into this trade war. Now, what does that mean for different areas of the economy? Again, I'm not going to touch on this on these areas as much as I would normally, just because, again, just in the interest of time, but please feel free to ask me any questions. So when we're looking at something like the job market, I think it's very, very important for anyone looking at the job market to remember that labor market indicators, so any of the data that we're looking at, are backwards looking. So they often reflect things that happen months or even quarters before. And that's because it takes time for a shock in the economy to actually ripple through to consumer demand, to business spending decisions, and then it starts rippling through to business hiring decisions, firing decisions, because it takes time for businesses to make those decisions. And so what we're seeing right now when it comes to the labor market, there's a lot of slack out there. It's very hard for people who are looking for a job to find a job. Very few people are hiring, if not outright firing. We saw some of those affected sectors by tariffs. So it is tough out there if you are looking for a job, but we're coming out of the pandemic when the job market was historically tight. The unemployment rate was at historical lows. A lot of people were either in a job, they were moving around. If one job is requiring you to come to the office, it was very easy for someone to say, nah, I'll just find another job. Thank you very much. A lot of people were hiring, a lot of job openings. Again, that has shifted. A lot of the reason why it has shifted is because again, those elevated interest rates still making their way through the economy. It takes some time for that to show up in the job market indicators, but also the fact that Canadian population was growing at its peak. It was over 3% year over year. And that is the highest growth rate that we have seen in this country since the baby boom. So that is a huge shock. We have so many people, or had so many people coming into this country looking for jobs, and we just weren't able to provide them with enough jobs. So of course, a lot of these people coming in are also then unemployed because they also can't find jobs. And so those are the two kind of main factors that were causing this deterioration in the labor market. But if you can see past our forecast line there, we are expecting some additional deterioration to flow through because, again, we are expecting economic growth to slow quite significantly. And in fact, again, that recession is going to have an impact here as well. So you can see kind of how, our tariff assumptions impact our economic assumptions, impact our assumptions for the labor market, and for other things like the housing market. So actually, before I get to the housing market, I just want to highlight here as well that what we've seen in the data is not just a deterioration in the Canadian labor market, but also a bigger deterioration in the labor market in Ontario and an even more meaningful deterioration for the labor market in Toronto. So Toronto's jobless rate is actually higher than the provincial average and higher than the national average. And we're seeing that again flow through to the housing market as well. There's a lot of regional divergence here. And there's actually a lot of ways to kind of slice and dice the housing market right now. One way to do here is to kind of look at how the housing market has fared since it peaked in 2022. So what this graph is showing is this 3-year change in prices from 2022, February 2022, when the market was at its peak, nationally speaking, to February 2025, which is the latest data that we have right now. So over this 3 years, obviously, a lot has changed. Coming out of the pandemic, or even during the pandemic, we of course saw a lot of people wanting to move to relatively cheaper areas. So whether they were moving, to a different province, or to the suburbs, the exurbs in southern Ontario, for example, because it was cheaper, because they could work from home, right? So what we are seeing is a lot of that effect has kind of pulled back in some regions, but it also does continue in other regions. So you can see at the top here, we've got Newfoundland and Labrador, Moncton, Calgary. Those are some of the more affordable, relatively most affordable regions in the country. But then on the flip side here, who's still struggling? Kitchener, Waterloo, London, Hamilton, Toronto. These are the regions that are dealing with, coming off of that froth for 2022. So a lot of that is just coming back to normal, but also they still remain quite unaffordable just on a levels basis. And so there are still people trying to leave those areas, going to those relatively more affordable areas. Another way to look at that, again, there's a huge regional difference right now in terms of the outcomes in the housing market. Another way to look at that is just, is the market in balance? And nationally speaking, yeah, it is, which is, again, is not something we've seen a lot in this country over the last few decades. Nationally, yes, we are in balance, but again, it really depends on where you are in the country. So we've got places like Edmonton and Calgary, again, 2 cities in Alberta. They are still in a bit of a seller's market. It's still a bit tight over there because, again, people want relatively cheaper living, but also because, again, there are better economic opportunities in Alberta. There's less of that tariff risk. But then we've got places in, Montreal, Quebec City, a lot of other smaller cities in Quebec, in the province of Quebec as well, some of the tightest in the country. But then on the flip side, again, from a buyer's perspective, there are some pretty decent conditions as well in southern Ontario, places where, again, that affordability still remains a challenge. We still see Toronto there. Again, this is as of February because we only have national data as of February, but we've already gotten March data for Toronto. We're expecting a little bit more softness, so a little bit further in terms of getting into the buyer's market for Toronto as well. And just zooming in even further to just Toronto here, you can see that sales activity does remain quite subdued. We are quite a bit down from kind of those the average that you would expect right now. And that is, again, because affordability does remain a challenge, but there is some opportunity there because sales are so weak right now. We do think that there are a lot of buyers that are staying on the sidelines, a lot of would-be buyers, a lot of would-be investors, because, again, they're waiting for interest rates to keep falling. They're waiting for that affordability picture to kind of come off a little bit here. And so when we're talking about affordability, again, there's a lot of ways to measure this. One of the ways we have here is the share of the mortgage payment as it relates to the rest of your household income. So you can see here that at its peak, the peak of unaffordability, so to speak, we had mortgage payments on average taking up more than half of a household's income. That is a little bit crazy if you just step back and look at it, right? We're at generational highs here. Thankfully, we did come off a little bit. A lot of that improvement actually didn't come necessarily from interest rates falling, because even though interest rates were falling, we still had some upside pressure on mortgage resets, right? So it wasn't necessarily that interest rates were falling so much that it helped affordability, but it was that incomes were rising so quickly that households were able to keep up and, in fact, on average, improve affordability from those generational highs. So you can see we are expecting a continued improvement in affordability, but only to a certain point. We're not actually expecting affordability to get back to normal levels, at least over the short term. And that's because, yes, interest rates are going to continue to fall. But again, we are expecting this slowdown in the job market, therefore slowdown in incomes. And so that's going to keep some of that pressure on affordability. So if we're looking ahead, again, I won't spend too much time on this because I've talked a little bit about our outlook for the housing market, but it's essentially slow and steady. So we're not expecting, a big rally thanks to lower interest rates, but we're also not expecting another correction in the housing market. Again, it will very much depend on where you are, but Ontario is likely to continue to follow the national trends in the sense that, again, very slow and steady recovery in sales activity and in prices, just as affordability starts coming back to slightly more normal levels. Now, if we turn to one of the major stories that we had in the Canadian economy, at least until we got to the tariff war or the trade war, it was population growth. So I did mention that population was growing at about 3% year over year up until the second half of last year. That was mostly due not to the fact that we were having more babies in this country, but because so many people were coming from outside of the country. Most of that immigration was non-permanent residents, and most of those non-permanent residents were international students. So that, and I will say, that overshadows anything else, right? So just the sheer number of people coming into this country, they were and are demanding housing, but they're not necessarily looking to buy a house because, again, they're not permanent residents here. And we'll touch on that again, but I just want to also point out the second kind of trend that we were seeing in population in Canada is, again, people who are already in this country, they're looking to move from those more expensive areas to those less expensive areas. And you can see this bar graph on the right is kind of showing you exactly where they're coming from, mostly Ontario, to some degree British Columbia, but province-wide, Ontario is much more expensive than BC is. Where are they going? Mostly Alberta, mostly the Atlantic provinces. So that shift away from less affordable to more affordable is something that we're still seeing right now. And I think that is what's being captured in all of the sales data. Again, going back to that international story, it's not necessarily sales that people are looking for, it's the rental market, right? Again, we're thinking non-permanent residents, a lot of them are students, a lot of them are young. They were often looking at things like condos, right? Smaller areas, and again, looking to rent. So now that as of the last school year, actually, the federal government introduced new immigration targets. So around the fall of 2024, we saw a big dip in immigration. And so we saw rents coming off their peak because of that. And so that's why we're seeing such a strong correlation between rental prices and population growth over the last few years. And so you can see we are actually expecting, based on the new targets for this year and next year, we are actually expecting immigration flows to even dip slightly negative over the next couple of years. And so that does indicate that there will be some additional pressure coming off of rental prices, again, over the next couple of years until we start to see things normalize a little bit more. Now on to the next big story, inflation. So inflation used to be, the only thing that I could talk about during the pandemic and after the pandemic, and for good reason. We did have multi-generational highs in inflation here in Canada. At its peak, inflation was just over 8% in Canada, and that's compared to a 2% target that the Bank of Canada tries to aim for on a sustainable basis. So from 8%, we were actually in a position where inflation was actually at or below that 2% target for about half a year. So things were looking pretty good. And again, on the inflation front, things are normalizing around, the end of last year. And on the economic activity front, things are starting to pick up again. So we were really in this Goldilocks soft landing scenario here in Canada until we got to tariffs. All of that on the inflation front also changed in February when the data started coming in again a bit hotter than expected. Inflation is now at 2.6%. So that's starting to get to the top end of the Bank of Canada's comfort range. So the Bank of Canada is again starting to get a little bit worried and, start looking a little bit hawkish. Maybe we need to keep rates higher for longer because inflation is starting to pick up. And in fact, the news for March probably doesn't look that great either because March was the first full month in which across the country we didn't have that sales tax holiday. So we're expecting prices to go up again in March. So again, the Bank of Canada is a little bit worried about that after, kind of thinking that, okay, maybe the inflation fight is over. It's looking like that might not be the case. That said, when we start looking beyond March to maybe April, what do we have in April? We have the elimination of the consumer carbon tax across the country. So again, prices could go down again in April. So all of that to say there's a lot going on in any given month in this country. The Bank of Canada, for its part, is trying to do its best to look beyond all of those moves, all those pressures going one way, all those pressures going another way, to see beyond what is temporary and try to figure out exactly what underlying inflation pressures are because they need to keep inflation at 2%. And so that's why we focus so much on inflation is because that's ultimately all that matters for interest rates. So the Bank of Canada's only mandate is to keep inflation at 2% with a comfort band of about 1 to 3%. But that is its only mandate. So really, unless something crazy, unless there's a shock that isn't related to inflation, the Bank of Canada is going to be solely focused on inflation. Now, like I said, we are expecting a shock in the form of a recession. So we do think that this tariff shock is actually going to outweigh inflation. But for right now, again, I'm just going to highlight the fact that we do expect 3 more rate cuts from the Bank of Canada. We are expecting them to be a little bit more cautious going forward. So they have been cutting essentially at consecutive meetings up until now. But starting this month, we actually do believe they're going to be a bit more cautious going forward because there's so much changing on the tariff front and because, again, domestic inflation is already starting to get a little bit too high for comfort. The last major thing that we're looking at here, of course, Canada has a federal election coming up by the end of the month. We get a lot of questions on exactly who we're expecting to win. I'm not going to say we don't actually have any official forecasts for an election because we're not political scientists, we are economists. But I think it is pretty clear that we've got 2 major parties kind of leading the polls right now in the Liberals and the Conservatives. We are, of course, watching a lot of policy promises quite closely. But I think it's kind of very early to be able to tell. We've got 2 debates coming up next week in both French and English. We also are waiting on their policy platform. So their official, promises on what they'll do on a number of areas like trade, like housing, like the environment, like taxes. So unfortunately, a little bit early to say, but that's something that we'll be watching quite closely. Now, finally, we've had a lot of conversation here on the risks, why things are so uncertain. We know that things are changing. The news is changing all the time. The way that I like to think about things is not necessarily, exactly what we're forecasting, right? The fact is that a lot of these numbers could very well be wrong, right? And again, there's a lot of disagreement here even amongst economists on Bay Street, even amongst economists in the same department, right? So at the end of the day, it doesn't really matter whether growth is at 0.5% in 2025, or if it's 0.4, 0.6, or even whether the Bank of Canada cuts 3 times or if it cuts 4 times. When you zoom out, it's not really going to matter to the big picture. What does matter, though, is managing those risks and knowing exactly where those risks lie. And so we have this slide here that kind of tries to picture exactly what those risks look like, where we have the red end of those bars meaning bad, green meaning good. And so for something like economic growth, right, we've got a very significant downside risk to economic growth. But for something like interest rates, we do have some upside risk. Upside meaning good, which means interest rates likely to fall further, right? So despite the fact that it's going to the right over there, it's actually a good thing. and that it's going down. And what does that mean for real estate? Again, we're not looking, it's looking a little bit subdued right now. Activity is looking a little soft, but again, the risk, where does the risk lie? It does lie towards, that more positive angle, because again, interest rates are likely to fall further. So that is one way that we try to focus and try to keep our sanity in these times that are moving quite drastically. So I'll kind of summarize things a little bit here before I move on to questions. We've got a lot of uncertainty coming out of the trade front, and despite the fact that a lot of these tariffs, trade barriers, they can look a little bit abstract and very, very confusing, the fact is that it matters. This stuff matters to the Canadian economy because it is quite highly dependent on the United States, which is, of course, its largest trading partner. So we are in this position where we do face a recession risk here in Canada, maybe less so in the United States, but still, a decent risk in the United States as well. And in Canada, again, we're coming into this trade war from a position of decent strength. Canadians are looking in better shape. They were looking like they wanted to buy a lot of goods and services by the end of the year. It's just that this trade war is looming very large in everyone's minds right now. And so with that, I am happy to answer any questions. And maybe I'll just leave things on the key takeaways slide.
All right. Well, thank you. That was amazing, Shelley. It was really great. So we do have a couple of questions.
Sure.
First one from Joseph. In the current Canadian housing and economic climate, with inflation, price volatility, and cross-border policy changes like new U.S. tariffs, how should a first-time or a cautious home buyer elevate their readiness if they feel they are in the comfort or fear zone rather than the learning or growth zone? What practical steps or mindset shift can help transition from hesitation to informed decision-making?
That's a great question. And I think, from my perspective, as an economist, as someone who's focused on the numbers, I think knowing a lot of these numbers is very helpful and is one way to kind of shift your mindset. As a first-time or would-be first-time home buyer, I totally get it. I'm a young millennial myself. I am renting right now too, so I totally understand where a lot of this stuff can come into play for a would-be first-time home buyer. It is a little bit uncertain out there. It is very volatile, but having that data, I think, really helps back things up. I think a lot of, looking back to history, Marianne touched on this as well, is past cycles. What do they look like? What do home prices look like when we're coming out of those cycles? Those kinds of things are very important and a good way to ground yourself, I think, when we're in this era where, it looks like everything has changed.
Right. I guess you're right. Being armed with the information alone helps you.
Exactly.
Right. Okay. So we have another question here. I'm not sure if this is the same, Joseph, but thank you again. In 2024, prices were 19% above the long-term trend, down from 33% previously, a 14% drop. While prices are still increasing, the slowdown could signal further cooling in 2025, 26, and 27. Why aren't current presentations showing projected future trends, and what indicators should we be watching to understand where the market is headed?
Well, I will show you my projected trends. To be fair, I didn't speak about this a lot, partially because our forecast is a little bit boring in that slow and steady kind of mindset. But the fact is, yes, we are expecting sales to kind of stabilize. We're expecting prices to stabilize and eventually catch up. But a big downside pressure on this is really that affordability calculation, especially here in Ontario, especially in Southern Ontario, where prices do remain quite elevated, at least on a historical basis, and at least when comparing to things like income. Oh. I'm just going to share my screen again. All right, so here's our forecast. Looking good? Okay. So again, we've got prices going up, but it's going to take a lot to get back to where we were, I think, because that affordability does remain a constraint. We do have some supports. I certainly don't want to gloss over those, especially on the demographic end. We still do have the tail end of millennials starting to, build families, look for more space. That is this underlying source of demographic demand that we have been experiencing. We've also got, a lot of the new immigrant population that has come into this country. Some of them, yes, are going to be leaving. A lot of them were non-permanent residents, but some of them might stay. And again, we have potential for new immigration targets for immigration to normalize starting in 2027. So once you start looking out beyond just this year and next year, you start looking ahead to, okay, is the immigration picture going to be changing drastically? Is the trade picture, the tariff picture going to be changing drastically? And in fact, it's really hard for me right now to determine with any degree of confidence exactly what the trade picture is going to look like next month, let alone next year, right? And so that's why I think people are hesitating a little bit when it comes to forecasts. But again, this is what we've got so far. It's a little bit slow and steady here.
Great. Now, we've gotten quite a number of questions, so I'm just going to answer some quick ones.
Okay.
Somebody had asked if they would have access to a recording of this presentation. The answer is yes. Now, somebody, I believe, asked earlier as well if they could get a copy of your presentation. Are these both available? Is that available as well?
Yes, we can share that as well.
Perfect. Okay, so we'll get back to some of our questions here. All right, why is Canada's GDP so low compared to other countries with virtually no successful tech companies since BlackBerry?
Great question. So GDP doesn't just focus on tech, of course, and I will just kind of be a little bit annoying here, but I assume you're talking about GDP growth and not the level of GDP, because Canada by levels is actually one of the richest countries in the world. GDP growth, yes, has been lagging, certainly been lagging behind the United States as well. A big reason, yes, you touched on that, is yes, tech has been a huge source, especially with the rise of AI, a huge source of growth, especially in the United States. We have less exposure to that, but we do have a lot of other sources of strength in GDP growth, things like consumers still powering the economy for better or for worse, things like energy, things like critical minerals, agriculture even. So we do have a number of supports here in Canada, but yes, the fact is that the tech piece is one of the reasons why Canadian GDP was lagging. But at the end of the day, when you look at the big picture for across all sectors, it really was the fact that interest rates were so high, and that was weighing on both consumer decisions and businesses decisions, across all sectors.
Wow, thank you. Well, here is a great juxtaposition question from Ashish. If Canada faces a recession risk impacting job markets, how are real estate prices expected to increase in the next 6 to 12 months as per your forecast? How will residents be able to afford purchase at current or higher real estate price levels?
Great question.
Right.
There are a lot of things moving, a lot of moving pieces. At the end of the day, part of it is just because it depends on exactly, again, where you're working. You might not be facing the same job pressures, depending on which sector you're trying to look for a job or which sector you're working in. On average, yes, we are expecting a deterioration, and we are expecting, again, an appreciation in housing prices. Part of that is just going to be, the fact that interest rates are coming down and are expected to keep coming down. We do think that that is going to help kind of the sentiment. We know how much sentiment drives the housing market. We do think, again, affordability is going to put a bit of a lid on that, but we do think sentiment is actually going to improve on average. Again, that's one of the downsides of being a macro economist looking at the whole country. This is really a game of averages, right? So it will depend on where you are. But yes, we do see some bounce back. Again, it is a buyer's market out there, so that is going to help sentiment once we kind of move through these initial tariff threats.
I love that you ended with that, because the next question actually is, do you suggest buyers buy homes now or wait for tariffs to be lifted? That is the golden question. So go ahead.
Honestly, if I had that answer, I would probably be not even a millionaire, a billionaire right now.
Right.
So I will just stress that I cannot give investment advice. So it really does depend on your individual financial situation. But what I will say is I don't know if it's the best idea to wait for tariffs to come off because,
Right.
again, we don't know exactly when this is
Right.
going to end. We don't know when all of this uncertainty is going to normalize, let alone when these tariffs are going to come off, right? So
Right.
we're in a position right now where, okay, we have this delay, we have this situation where the US has only 10% tariffs on most countries. Is that normal? We don't know, right? The president can change his mind tomorrow, right?
Right.
So we don't know
Right.
yet until things calm down that things are actually coming.
Yeah, I mean, you can't negotiate with crazy, right? So, what prediction for mortgage rates for the next 5 years, year over year? What ups and downs may we expect in coming years? Again, I think you'd be a billionaire if you had this answer, but
I really wish I knew. Unfortunately, it's not a cop-out to say we don't know.
Yeah.
It's just so uncertain.
It kind of goes with what I was thinking because, you know, rates have been coming down. The Bank of Canada's been dropping rates, but then we know if a recession's around the corner, that will go back up. So I guess my question is, do we foresee any more rate drops before the recession, or is the recession coming pretty quickly in your mind?
So the timing of a recession is one of those things that are very, very fine-tooth. A lot of people think it might be coming earlier or later. We think it's going to start in the second quarter, so now essentially. But actually, so the Bank of Canada, again, it has been already lowering rates. It has been
Right.
cutting. The last two meetings where it cut at 25 basis points each, they did actually mention this tariff risk. So it's already been kind of built into their risk management
Right.
perspective. And so that's actually why we think they're going to start slowing down, being more cautious for future rate cuts, is because they've already kind of built in at least the initial impact of this uncertainty on their forecasts and on their rate decisions. So if we're looking ahead, if we're looking ahead, again, we do expect them to stop cutting after 3 more rate cuts. Beyond that, it's very hard to tell. We're likely going to see some normalization in economic conditions and so some normalization in interest rates. But I think right now it's safe to say that rates are likely going to remain a bit higher than they were coming out of the pandemic when we had those record low mortgage rates.
Okay, thank you. Do you anticipate, oh my goodness, I lost my question. Oh, there it is. Do you anticipate the increased unemployment in Ontario to fully offset any possible upside in real estate price from the lower interest rates?
I don't think so because, again, the forecast for Ontario is definitely slow and steady recovery. So we still on net are expecting a recovery in Ontario because, again, things are looking pretty good from a buyer's perspective right now. The thing with Ontario, especially Ontario's job market, is it's very important to remember that a lot of this deterioration came from that population growth that we experienced over the last few years. And again, a lot of that population growth was in non-permanent residents. So it was people that aren't necessarily in the housing market itself to begin with. And so if we're taking that out, likely going to have a very minimal impact on at least the market to buy and sell a house.
Right. All right. Aside from housing cost, what contributors are there? Did you see how that question keeps moving? What contributors are there to the increasing inflation costs outside of the HST pause and now with the carbon tax pause elimination, which I've heard keeps going back and forth, but anyway.
So just a technical note. So the carbon tax itself, legislatively, it's still in place, but the rate itself is 0. So that's why people sometimes call it an elimination, sometimes a pause, because legally they could change the rate to anything else at any time. So yeah, your question is, what are these sources of inflation other than the housing market? A lot of it is the housing market, unfortunately or fortunately, depending on who you are. Mortgage rates, home insurance, rent prices, all of those are the major upside drivers to inflation. And in fact, when I was talking about inflation being at or below target, a lot of that was because everything else was either falling or rising at a kind of a normal rate, except housing.
Right.
Now, again, we have February coming in stronger than expected. A lot of things, it's very broad-based. It's a lot of goods, especially pretty much everything, especially things that were subject to the sales tax holiday, increasing a little bit stronger than we'd like to see. So it still remains to be seen if, again, it's going to be this broad-based strength like we saw earlier, or if that it's really going to be a housing market story. I think it's too early to tell just because, again, there's so many moving pieces here with the tariffs and with the carbon tax.
Right, right. We do have some questions, but I just read an amazing comment and I have to share it. Dear Fides team, thank you so much for taking time to answer all of our questions with such clarity and depth. Your insights were thoughtful, timely, and incredibly helpful, especially in today's complex economic climate. Your ability to break down key financial market factors made the session not only informative, but truly engaging. I genuinely appreciate your honest, practical advice and the way you address both short-term concerns and long-term strategies. You've made a real impact. I'm grateful for your expertise and generosity in sharing it. Wishing you continued success and looking forward to the future sessions. Joseph, right back at you. Thank you so much. What an amazing comment.
Thank you.
All right, so we have maybe one or two questions depending on timeline here. So
try to be short.
Right, here we're going to go. With the GDP flatlined or even expected recession by the end of the year, Canada is way over leveraged compared to the US on real estate. With wages falling way behind the affordability, there is still a big gap. Government trying to increase supply, housing maintenance going up. You think due to over-leveraged people are forced to turn their keys in or the government bails out, just kicking the can down the road?
Very good question. So the reason why the Canadian economy is so sensitive to changes in interest rates is because you hit the nail on the head right there, is because Canadian households are so highly leveraged. The level of debt is just much higher as a share of income compared to any other country, at least any other comparable country. Whether or not that is a crisis that, would potentially get policymakers to get involved, I don't think we're there yet. Some of the offsetting impact of the fact that rates were so high is that households became much more deleveraged. So things are looking a little bit better, at least compared to a few years ago. It does remain quite a bit of a problem. It does impact, household budgets every single day. But I don't think we're in a situation where this would necessarily, be cause for concern or even, threaten financial stability. It is something that the Bank of Canada is watching. It's something that the government's watching. But yeah, I don't think there's any appetite for action right now.
Right. This also falls under your economic purview. How does Varan stay so handsome?
Great question. Got to drop the skincare routine, right?
That's right. All right, here we go. How can economists disagree on forecasting if market trends, that disappeared again. Oh, market trends are analyzed by similar models and data and such. Like, what is the validity of these results and how can we make decisions based on the results if there's so much variation?
Great question, especially right now. I will say a couple of things. So very different models depending on who you speak to. Usually the same amount or same types of data, but the market, I think, is operating, again, depends on which market you're talking about. Markets operate very, very differently. They're looking at very different things. They tend to react much faster. Again, it depends on which market you're looking at, but the swings from yesterday afternoon are a great example of that, right? We can't necessarily change our economic forecast based on, the news of the day. Markets do, right? So that's one thing. They are, of course, still looking at the same economic data that we are looking at, but we spend a lot more time going into the details. But human nature is what it is. There are different details that might, correspond to different things. People weigh them differently depending on their model, depending on their own biases. So looking back, if you're asking, exactly how do we listen to all of this, the answer is really just try to read as much as you can, try to look at the data yourself, try to, look at analysis from a number of different sources. It is really a matter of trying to get the big picture here in order to fully figure out what exactly is going on.
Great. All right. We will have time for one more question. Let's see. Terminal rate. What is the Bank of Canada's terminal rate and when, and what is your forecast?
So the terminal rate is, I'm just going to take a step back here. It's the rate that we expect the policy rate to be at when the bank stops cutting. So when it stops its easing cycle, when it terminates its easing cycle, we expect that rate to be 2%. Again, some other shops have different forecasts there. We're expecting 2%. It's currently, the policy rate is currently at 2.75%. So again, 75 basis points still to go total in easing. We don't think they're going to get there until December. But again, that timing is very, very fluid. It will really depend on the data to come yet on inflation and the data to come on economic activity. Because I think one thing to keep in mind, a lot of the data we've had so far is pre-tariff, pre-trade war. So if you think back to all the way back to early March, that's when the trade war really became a thing in the minds of the Canadian economy, right? And we don't even have a lot of data yet for March. So this is something that we're going to start seeing happening more and more in the months to come.
Wow. Well, Shelley, you have been a wealth of information. Thank you so much. And to all of you, I'd like to say we've had a number of great messages in regards to the feedback and what you've taken away today. The Fides team would love you to post those messages and tag us, because we had an incredible turnout today, but we still had a few people that weren't able to make it. And we want to make sure that they know that, next time this opportunity comes around, to really try and be here, because it's such a great wealth of information. So again, on behalf of Fides Mortgage, thank you so much. Baran.
Thank you, Shelley. Thank you, Doreen, for hosting it.
Thank you,
Elaine. Thank you, Marianne. Thank you, Chris. Thank you, everyone. And we're looking forward to host another session in person, and stay tuned. We'll send you guys the details. Thank you. And thank you for Team Fides to organize this and getting the message across. And we did pretty good. Thank you.
It was a great day. Morning.
Thank you.
Thank you.